John, so, Sarah, we were talking about Warren Buffett's value investing. The idea of buying undervalued companies and holding for the long term seems like a solid strategy, especially for someone like me on a limited budget. But is that enough to build real wealth over time? Sarah, it's definitely a great foundation. Buffett's strategy is really about patience and understanding the value of a business, not just its stock price. For middle-class investors, it's a great way to slowly grow wealth over time. But if we also consider Robert Kiyosaki's Rich Dad, Poor Dad, we realize wealth isn't just about holding onto assets. It's about generating cash flow and using assets to create income streams. John, right, Kiyosaki's all about passive income and focusing on assets that put money in your pocket. That seems different from Buffett's focus on long-term value. But how do we mix those two? Sarah, they're actually more complementary than you might think. With Buffett, you invest in stocks with a long-term horizon, but that doesn't mean you ignore the concept of cash flow. Kiyosaki talks a lot about real estate and small businesses that provide steady income, which is a different kind of asset from stocks. Combining both methods gives you growth with Buffett's approach and income through Kiyosaki's strategies. John, so, for someone like me who doesn't have a ton of money, where do I start? Should I invest in stocks for the long term or focus on income-generating assets? Sarah, start where you're comfortable, but the key is understanding both approaches. If you're new to investing, maybe begin with Buffett's strategy, buying undervalued stocks or low-cost index funds. Once you build up some capital, you can move into Kiyosaki's realm by acquiring rental properties or small businesses. It's about finding balance. Over time, you'll want both long-term growth and immediate income. John, I like that. It feels more achievable than trying to pick one path. So, for someone nearing retirement, should the focus be more on one strategy over the other? Sarah, Buffett would say stability becomes more important as you approach retirement. That's where dividend-paying stocks or bonds come in. You want to preserve your wealth while still earning income from your investments. But Kiyosaki's philosophy still holds: if you've built up enough assets that generate cash flow, like rental properties or a small business, you can live off that income in retirement without needing to dip into your investments. John, makes sense. So, what does that look like in practice? For example, say I'm in my 30s, and I want to retire comfortably. How do I set myself up using both strategies? Sarah, in your 30s you've got time on your side, so start by investing for long-term growth. Look for undervalued stocks or invest in index funds that track the market. At the same time, build up your financial education. That's something both Buffett and Kiyosaki stress. Once you understand how money works, you can make smarter decisions. Over time, start diversifying into assets that produce cash flow, maybe a rental property or a small side business. The goal is to have your long-term investments grow while your cash flow assets provide income for daily expenses. John, so, by the time I reach retirement, I'll have this portfolio of assets that's both growing and generating income. Sarah, exactly. By blending both approaches, you create a financial safety net. Your stock investments grow in value, and your real estate or business provides cash flow, allowing you to live comfortably without having to rely on just one income source. John, and what's the mindset shift required for that? Both Buffett and Kiyosaki talk a lot about mindset, but in different ways. Sarah, Buffett emphasizes patience and discipline. You can't get rich overnight with value investing. You need to be okay with holding on to stocks for years, even decades. On the other hand, Kiyosaki talks about shifting from working for money to having money work for you. He stresses financial education and the importance of assets over liabilities. The mindset shift is understanding that wealth building is a long-term game, and you need to invest in assets that will work for you, whether it's through capital appreciation or cash flow. John, right. I guess for people in the middle or low-income classes, it's not about making huge investments up front. It's about starting small, learning, and growing over time. Sarah, exactly. Both Buffett and Kiyosaki would agree on that. Whether it's buying a few shares of a strong company or saving up for a down payment on a rental property, the key is to start where you are. Don't be afraid to take small steps, as long as those steps are moving you toward wealth creation. Consistency is key. John, so, if I focus on investing in what I understand, like Buffett says, and I start building assets that generate cash flow like Kiyosaki suggests, I'll be on the right track for retirement. Sarah, yes. It's not about picking one strategy over the other. The power comes from blending both approaches. Use value investing to grow your wealth and Kiyosaki's cash flow strategy to ensure you have the income you need day to day. Over time, you'll have the best of both worlds, long-term growth and consistent cash flow. John, this has been super helpful, Sarah. I'm starting to see how these two approaches don't just work for millionaires, they're strategies we can use right now. Sarah, absolutely. It's all about taking action and staying committed. As Buffett would say, the market rewards patience, and as Kiyosaki would add, it also rewards those who know how to make money work for them. John, I'm excited to get started. Thanks for breaking it down with me. Sarah, anytime, John. Here's to building wealth smartly.